Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of the big stock stories of the day is CVS, the healthcare company CVS. Stocks down today. Management changes, never a good thing. We wanted to get to the bottom of it because a lot of people don't really know what CVS is. It's not CBS, the television network. It's C as in and Victor and S. CVS. Jonathan Palmer, he knows what's going on. He's a senior healthcare analyst for Bloomberg Intelligence. Hey, Jonathan, thanks so much for joining us. I know you know this company well. Can you tell us what CVS is and why the stock is down today? What's going on there?
Yeah, Paul, thanks for having me on. So, most people think of CVS as their corner drugstore, but really it's a far bigger healthcare company in the ecosystem than just that pharmacy that you see around your corner. They own the benefits manager Aetna, and they also own what's called a large PBM, a pharmacy benefit manager called Caremark. So really it's a vertically integrated enterprise that most people know as their corner pharmacy, but actually has a far bigger reach through the insurance side of the business as well. So the stock's down today. They pre-announced earnings that missed. They announced a management change. The CEO has left. They're calling it a resignation, but this was really probably the last straw in her tenure. And they've promoted the head of Caremark, the benefits manager and a longtime employee, to become the new CEO.
Talk us through the buildup to this management change. What was going on exactly?
Yeah, so the story of CVS, or the narrative on the stock, has been one of missed expectations. They've been trying to get back to double-digit EPS growth, and they've put that out in the outer years, and they keep pulling back on that guidance. Both reaching that milestone, but also every year they've been kind of missing their EPS guidance, and so they'd already revised guidance down last year. They revised guidance down with 2Q earnings last quarter. And so really, I think it's a question of execution. The CEO just hasn't executed on the game plan that she espoused. And so they've got little they can do to kind of turn the story around other than making a management change.
30 seconds, Jonathan. Do you think it can be done, and in what time frame?
Yeah, I do. I think it's going to take a lot of blocking and tackling. But the hard part about this business is it's based on contracts, and contracts are typically 2 to 3 years. And so it's going to take some time to work through the headwinds that they're facing in their benefits business on the pharmacy side. But these can be overcome.
All right, Jonathan, thanks so much for joining us. Jonathan Palmer, senior healthcare analyst for Bloomberg Intelligence, joining us via Zoom, talking about CVS Health. The economics of the healthcare business. I don't pretend to understand that. I think they're one of the most complex businesses to analyze, so we're glad we have smart people like Jonathan Palmer.
But the coupons are good.
Happening. What's that?
The coupons are good.
Coupons are good.
We get some really good coupons for CVS through our CVS Caremark.
Yeah, but in New York City,
consumers have
weekly.
Exactly. Exactly. There you go. Stock off 8.5% today. So again, maybe this is a little bit of a kitchen sink moment for the company. As Jonathan Palmer suggested, there is a path towards improved profitability there. So we'll see how they do there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
China. It's front and center, not just for folks that invest in China or in emerging markets, but it's, one could argue, as the second largest economy in the world, everybody has to have a view on China. Our next guest does. Gerard Dipippo, senior Geo-Economics Analyst for Bloomberg Economics, joins us. Gerard, I guess the question a lot of people have as it relates to China is, are there fiscal and monetary moves to support this economy? Are they enough? What do you think at this stage?
So they've already announced monetary policies a few weeks ago. Those, by their standards, are fairly aggressive. The big question is how big will the fiscal policies be? The Ministry of Finance had a press conference on Saturday where reporters asked many questions, but they didn't provide any actual number. The reason for that is that in China, they actually need the legislator to approve any change in fiscal policy, like government borrowing. they won't be meeting until probably late October, possibly early November. So we don't actually know. But I think that the general consensus is that there was sort of this initial euphoria in late September, which explains the massive stock market rally, that they were going to do this big bang stimulus. They kind of are on the monetary side, but it's not exactly clear yet whether they're going to do it on the fiscal side. But what sort of qualitatively what they're saying suggests that the early hopes of doing sort of a big consumer-oriented fiscal stimulus, that's likely not going to happen. But we're still waiting for the top line number.
So what does this all mean for investors who are interested in equities in China?
So, I mean, it was a good day for equities in China. The two big things that happened today were they put out their Q3 data, which is generally above consensus in how well it did, including for GDP. The other thing that might have helped for the stock market was that the PBOC reiterated that it has these swap facilities, including to help companies buy back shares, which then puts up the stock market. In general, the stock market has done well over the last few weeks, but over the past year, not so much. The Chinese stock market has sort of a feast or famine tendency when it comes to sort of boom and busts. This has happened over the past decade or so. It often sort of appears to underperform, and then there's a lot of euphoria, and a lot of that is often based on what the government is doing. So I think what everyone is waiting for now is, again, what is the actual top line number for fiscal stimulus? Because if it comes in below expectations, the rally, which has already given up some of its gains, could give up even more. But if it's actually at that level, 3 trillion RMB, maybe more, then you could see some upside.
Hey, Gerard, I see that the China GDP numbers recently came out. It rose 4.6% from last year. That's the slowest pace in 6 quarters. Is there still room to go in terms of decelerating growth, or economists out there, are they saying, hey, maybe we're at or near the bottom?
So at Bloomberg Economics, we think they're probably at the bottom in terms of top line GDP growth, and in general, the data was fairly good. So industrial production, retail sales, fixed asset investment were all just slightly above the consensus. But the sort of broader bad news is that those things are still generally below the sequential trend. So consumption, particularly retail sales, is still well below its pre-pandemic trend. And the bottom line is that even though the sort of top line number might have bottomed out, the economy needs more stimulus, and that's what everyone's waiting for. And the big thing in particular is really two that are related. One is the property sector, which the government said it intends to stabilize, probably through stabilizing purchases, not investment or prices per se. And the other thing that's related to that is consumption or consumer confidence, which is integral linked to the property sector, which is where people have their savings.
So what further risks are out there, especially as we dig a bit deeper into the property market that they did say has still yet to stabilize?
Well, so in the property sector, I mean, the main thing is that, one of them is that the property developers are still in a tough spot. They are in the process of recapitalizing banks, in part so the banks can lend to the property developers and help stabilize that. But ultimately, you have to get sales back. You have to basically get the confidence back in. And what's tricky for the Chinese government is they actually wanted to deflate the property sector. It was a property bubble. They have deflated it. It needed to happen. But then what they don't want to do is reinflate it to restabilize the economy. So they're walking a sort of a tightrope at the moment with that.
What are the next data points that we need to be looking for China here?
I mean, we would the high frequency indicators like PMIs or in general things like retail sales. The thing that the event to look forward to would be the National People's Congress meeting that will be happening probably in a few weeks, okay. And that is when they'll announce the big stimulus or whatever the number is.
That'll be interesting to see because a lot of folks and a lot of, I think, investments are weighing in large part on what the Chinese government will do here. Gerard, thanks so much for joining us. Gerard Dipippo, Senior Geo-Economics Analyst for Bloomberg Economics, giving us the latest on the monetary and fiscal stimulus in China. Again, the GDP last period rose 4.6% from last year, but that was the slowest pace in 6 years.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Our good friends over at Netflix, NFLX is the ticker symbol. They reported numbers last night, beat the street, some good guidance, some good discussion around kind of the growth outlook. The stock's up 10% today, 52-week high. I'm guessing that's probably close to an all-time high. $325 billion market cap. I don't know what's going on there. Geetha Ranganathan does, because she's the analyst at Bloomberg Intelligence who follows Netflix. Boy, what happened last night? What did Netflix report, Geetha?
Yeah, Netflix had an actually very, very high quality earnings report last night, Paul. So they were up on subscriber metrics. They came in ahead of consensus. But I think really what excited the street was they were ahead in terms of guidance, both for the fourth quarter revenue guidance as well as operating margin guidance. And their outlook for 2025 was slightly ahead of consensus. And mind you, it was slightly ahead of consensus just based on subscriber growth. So the two big growth levers that everybody was expecting they would pull, one was, of course, the ad business. That doesn't look like it's going to be a huge contributor in 2025. It looks more like a 2026 event. And then, of course, the event that we were all waiting for, which was, a price increase on their standard plan in the US. And they didn't announce that. And so the fact that they're able to guide to solid double-digit revenue growth without pulling any of those growth levers just tells us that there's a lot more juice left in this business, even with, just plain subscriber growth.
Right. Lots of good news coming out of this report. Where are some areas that they could have done better? Is there any areas that people are critiquing?
I think the areas that people are critiquing is really just the lack of disclosure around advertising. And one can understand why they are holding their cards close to their chest. So this is still a very small business. They have not disclosed the number of subscribers that they have on the ad tier. And that's, color that investors and the whole investment community has kind of been looking for a long time. But they did give us some qualitative kind of guidelines, right? They said that, yes, we are growing pretty fast, but it's off a small base. Don't expect the advertising business to be a huge growth driver in 2025. But I think come 2026, that completely changes.
Where are we on programming budgets, Geetha? Because I think one of the things that you and I worked together, we were just shocked at the early days of Netflix and the types of money they were willing to spend, the billions of dollars they're willing to spend on their programming budget, and that forced everybody else to kind of keep pace. Where are they with their spending strategy? Do they have to keep spending to get subscribers?
I think they do, but they're doing it in a much more intelligent, much more efficient way. And the ROI on the content spend has absolutely, increased so much, Paul. And that's just because, it's been a function of just the operating leverage that they have in the model with the scale and the way that they're able to spread those costs over, a 285 million subscriber base. So, yes, there has been some content cost rationalization across the board, including Netflix. They are still spending about $17 billion this year on content, which makes them one of the biggest spenders in the streaming space. They are planning to increase their budget a little bit going forward. So I think close to about $18 billion in 2025 is what the general estimate is. But then again, remember, they are looking to build out an ad business. And for ads, you do need to invest in different kinds of programming, not really the heavy entertainment programming. It probably has to be more a live sports or a live events type of strategy. And they, I think, are willing to kind of splurge on that to really build up and scale up that ad business.
How's the debt looking on their balance sheet? I know they're big spenders, especially as we think about all the shows and the movies that they're rolling out. Are they staying above water?
Oh, very, very much so. They have about $14 billion in debt, but remember, they have over $7 billion in cash on their balance sheet, and they're going to throw out $6 billion this year. So, absolutely in very, very good shape.
So the $64,000 question, Geetha, which I'm sure you get asked by your institutional investor clients all the time, is how about everybody else? When you see a Netflix quarter like this, you're like, boy, how's everybody else going to compete against these guys in the streaming world? What are you saying to them?
Yeah, so they definitely, Netflix has definitely won the streaming wars. They're going to keep it that way. We know that they have about 10% of all viewing time in the United States. So they obviously see much more upside for themselves to kind of grow. And I think that's exactly what's going to happen, as they have more and more plans, cheaper plans with, of course, the advertising based tier. And of course, as they have more and more must have content. So there's definitely the competitive intensity is absolutely easing, which allows them to be a dominant player. But I think also Netflix is really showing the other players how it's done. So one of the big points that came out yesterday from their earnings report was the fact that they've increased margins. Remember, at the start of 2024, they said 22% operating margin. Yesterday, they're saying 27% operating margin for 2024. And remember, Paul, I mean, you know this well, the bogey has always been about 35% margins, and it looks like they're going to be able to get there in the next couple of years. So this is going to be, and probably even more profitable model than the traditional TV model, which is great news.
Well, I'm not seeing that, or are we going to see that with some of the other traditional media companies which are still chasing profitability? Because if you say it can be done, I'd go out there and take a flyer on Warner Brothers Discovery. I'd take a flyer maybe even on Paramount if you're saying that model can be profitable.
Yeah, it can be profitable, but of course, it depends on so many other factors. I think Disney is definitely in the strongest position to kind of replicate this success. The other is not so much because, again, scale is going to be a huge issue for them. Marketing cost is going to be a huge issue for them. They just don't have that clout or the firepower that, Netflix and Disney kind of have with their IP and their franchises.
I mean, after these results, it seems like a bit of a positive start so far when we're thinking about those sort of former FANG names. What is the next thing that investors are looking for? Has the company talked anything about new projects that they're rolling out? What are investors on the watch for?
Yeah, so the new projects right now, Norah, of course, the big thing that everybody has kind of got their hat hanging on is the advertising business and how big that can potentially be when it takes off in a big way. They also, of course, again, are making this big, splash or this big foray into live events. So you have, the NFL games that are going to come up. You have that Jake Paul versus Mike Tyson event. The question is, how many more of those are they going to do? And will those actually be a big needle mover for them? And then, of course, we have them kind of taken, these baby steps in the gaming industry. Again, not necessarily being a game changer so far, but over time, it certainly can be. So they have these different ancillary revenue streams that can definitely build and kind of increase their not only their catalog of content, but also their competitive positioning, as in strengthening their competitive positioning.
All right, Geetha.
I need some tips on how to get around the sharing.
Well, that's the thing. I mean, Geetha, that sharing thing,
please.
That helps them out, right? Cutting
it
down
helps
on that?
them out huge. Big time. 100 million subscribers is the opportunity that they outlined there. So, and they've
identified the Tucker offspring, I think, as revenue opportunity.
The deadbeats like me.
The deadbeats.
I
need to get around this.
I know. All right, Geetha, thanks so much. Geetha Ranganathan, she's a media analyst for Bloomberg Intelligence, and I'll note she's
What's the
in
big
the
show
office.
on Netflix nowadays?
I don't know.
Since I don't get it anymore.
Love is Blind.
You were cribbing off of one of your kids?
No, I'm not going to make any of
Don't expose yourself.
It's called sharing.
Right, sharing is caring.
Yeah.
Thank you.
The Sweeney offspring
That's what
were
I say.
shocked when this happened.
Oh, I cried.
They were calling me up Dad, what'd you do? You cut us off. I said, I didn't cut you off.
My dad was like, I don't even know how to work this.
Exactly.
Cut it off.
Somebody cut you off. That's why we own the stock. It's one of the many reasons. Deadbeats like you are off the dole. So that's important. And the advertising, as Geetha said, is a 25-26 event that investors can hold their hats on as they look for growth to continue to support that multiple there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Hamas officials, they have confirmed the death of Hamas leader Yahya Sinwar, who was said to be the architect behind the October 7th attack. Earlier today, President Joe Biden spoke on Sinwar's death, seeing it as a, quote, moment of justice, end quote, while also renewing the call for a ceasefire deal. Let's take a listen.
The death of the leader of Hamas represents a moment of justice. He had the blood of Americans and Israelis, Palestinians and Germans and so many others on his hands. I told the Prime Minister of Israel yesterday, let's also make this moment an opportunity to seek a path to peace, a better future in Gaza without Hamas.
All right, that was President Biden earlier today. Speaking about the death of Sinwar's death, again, calling it a moment of justice. Let's break it down a little bit farther when we talk geopolitics in the Middle East. Some smart voices help us out there. Jonathan Schanzer, he's the Senior Vice President for Research. He's at the Nonpartisan Foundation for Defense of Democracies think tank, joins us from Washington, D.C. via Zoom. Jonathan, what do you make of this latest news? I mean, the Israelis seem to be quite successful targeting leaders of Hamas and Hezbollah. What do you think their strategy is right now?
Well, first, I think we need to acknowledge something, that yesterday's strike against Sinwar was dumb luck. The Israelis have pulled off a lot of serious operations in places like Lebanon or Iran. In Gaza, this was the result of a couple of younger IDF soldiers simply happenstance falling upon Sinwar's position after a brief altercation. They called in a tank strike and ended up killing him. Really just a remarkable turn of events. But what the Israelis have done, outside of this particular strike that killed Sinwar, is they have just been using their intelligence advantage. They've been using their technology advantage to effectively eviscerate Hamas. They've got Hezbollah on the ropes. They're now preparing for a strike against the Iranians. I think the expectation there is they're going to take away some of Iran's capabilities. This has been not the war that the Israelis wanted to fight. It's been a war of attrition. It's been fought in some cases on their turf that runs 180 degrees away from their doctrine, which is fighting fast wars on other people's turf. But you get the sense right now that through these precision strikes, through the technology, through their comparative advantage, they're starting to gain the upper hand against the Iranians and 6 or 7 other proxies, which is truly a formidable axis that they are fighting. But you do get a sense that they're starting to make some headway.
Jonathan, this war has been going on for over a year. What chapter are we in? How much closer are we to a truce? What are people saying?
Yeah, look, I think there's a possibility of possibly getting to a truce with Hamas. Because they've just been eviscerated, right? I mean, I think they have to, at some point, understand that fighting is just not worth it any longer. Not for the people of Gaza, not for the organization itself. They're still holding 101 hostages, including, I believe, 7 Americans right now. A deal can be cut that would end the fighting in Gaza, but I think we need to all be clear about something. This 7-front war that the Iranians are waging against Israel, that's going to keep going. And we're seeing it now. Hezbollah has declared that they're going to up the ante and possibly use more advanced weapons against Israel than we've seen so far deployed in that theater. The Houthis are still at it. The Shiite militias in Iraq and Syria are still at it. The various terrorist groups that have been attacking Israel out of the West Bank, they're still at it. And then, of course, there's Iran itself, which recently lobbed 181 ballistic missiles at Israel in one night. So this war is going to continue on other fronts, but certainly it would be welcome to see the fighting finally stop in Gaza. It would be a welcome relief for the people of Gaza, who really do, I think, need to see that place go under some serious reconstruction, both politically and physically. That needs to happen sooner rather than later. But the war, the broader war in the Middle East, is going to continue.
Yeah, Jonathan, it seems like, in this year that there's been this hostilities in the Middle East, it's gone from a limited war in Hamas to simply, eviscerate Hamas and get the hostages back, to a much, much broader regional conflict, something that the U.S. wanted to avoid here. But it feels like the Israelis recognize this as a moment in time where they can settle everything, everywhere in the region. Is that what you're thinking at this point?
Look, I think first to frame this properly, you have to understand that what started with Hamas, it was never about, Hamas versus Israel or Israel versus the Palestinians or, a war in Gaza. This was an Iranian proxy, Hamas, waging war against Israel and then opening up multiple fronts at once. And so now we're seeing all those fronts. It's become even more clear, I think. It was a clarifying moment yesterday. With Sinwar gone, you begin to see that these other fronts haven't stopped. And if anything, they may actually only get hotter. And so I think for many of us here in the West, it was kind of an aha moment where we say, okay, wow, this really is a wider war and Iran is behind it. Now, Israel, I think, has some choices in front of it, right? It can try to fight to a ceasefire in Lebanon, where, maybe Hezbollah is forced to withdraw above the Litani River, which is, what was enshrined in international law after the last war in 2006. But it doesn't solve for all of the other challenges that Israel's still facing. These Shiite militias that have been, firing drones and rockets and missiles at Israel over the last year, they're still a problem. The regime itself is still the big problem. And the biggest problem of all is that Iran is still flirting with that nuclear weapon. They may use all of this as a distraction to make a dash to that bomb. And then the entire map changes in the Middle East. You've got basically a regime that is as malign as North Korea in the heart of the Middle East, threatening to pull the trigger at any time and using, by the way, a nuke as the ultimate insurance policy to be able to continue the kind of mayhem that we've been watching. So the Israelis, I think, are looking at all these, and I think they're clear-eyed about it. They see the need to bring down the regime in Iran. I don't know if they can do so without help from the United States, or maybe more importantly, help from the Iranian people. These are people that truly hate their regime. And I think we're now starting to see a strategy take shape where the Israelis the Israeli prime minister spoke directly to the Iranian people a little bit more than a week ago, enlisting them in the battle against their mutual enemy.
Jonathan, thanks so much for giving us a few minutes of your time. Really appreciate it. Jonathan Schanzer, Senior Vice President for Research at the Nonpartisan Foundation for Defense of Democracies. That's a think tank in Washington, D.C. There are a lot of smart people out there that help us understand what's going on in a very difficult part of the world. We appreciate getting a few minutes of Jonathan's time there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Mulinda sitting in for Alex Steele. I am Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube as well, so check us out there. Sylvia Jablonski joins us. She's the Chief Executive Officer and Chief Investment Officer at Defiance ETFs. So we're going to talk the market with Sylvia, and I also want to talk ETFs because I'm just continue to be shocked at the amount of money going into the ETF space. It's one of the great stories of during my career on Wall Street to see the funds flow there. Sylvia, thanks so much for joining us here. We've got a lot of economic data that looks pretty solid. Maybe a lot of folks in that soft landing camp, I think they're feeling pretty comfortable. With that kind of backdrop, where are you telling your clients to allocate capital these days?
Hi, Paul. Thanks for having me. And first of all, I would like to have a Vespa to whiz around the Jersey Shore with. That sounds like a lot of fun. Yeah, I think, I think the markets are in a good spot, right? It all kind of started, the momentum restarted, I should say, with that jobs number that looked a little bit better after concerns of the reports prior. Inflation is looking good. So we have the situation now where monetary policy is becoming a little bit more favorable. We have steady jobs, we have wage growth, we have consumer sentiment, pretty solid, and consumer spending. And then earnings are holding up, right? So while valuations are high, companies are proving that they're profitable and that they're continuing to grow. So it does feel a little bit like a Goldilocks market right now. Particularly, we're going into that seasonally strong time of year next month. We have an election year. I think it's going to be a pretty good ending to the S&P 500 and NASDAQ. And so where do you allocate? Whenever the market pulls back on dips in AI stocks, I always buy them. We've talked about that. A lot of people probably already know my picks there, right? The NVIDIAs, the AMDs, super micro strategies. But I'm also starting to allocate to XMAG. So the other 293 stocks in the S&P 500 that are kind of forgotten over the last couple of years. I think they're going to start having their day in the sun.
What areas are you avoiding?
I think the breadth is increasing in the market, and I think that the overall market is starting to perform. So it's not that I'm necessarily avoiding a particular sector. I think if I look at the Mag 7, for example, actually there's only 2 of them that are now outperforming the S&P 500, and that's NVIDIA and Meta, and the others, although Apple might have picked up after the last couple of days, but the others are kind of slowing down in terms of outperformance. And so I'm not really looking to pick up like the classic Mag 7. But that's not to say that I'm selling the positions that I already have. I think if I just put new money to work, I'm going to be a little bit more thoughtful about where I diversify it. And that probably will be away from some of these names that have, flown high.
You've got Exxon in your notes here.
Yeah.
That's a name we don't talk about, I think, enough here. And John Tucker and I were just talking about oil coming back down now below $70 a barrel for WTI crude oil. What's the investor call on Exxon?
Yeah, I mean, that's why I like it, right? I think it's come down quite a bit, but if you look at what's going on in the rest of the world, to me, this is a bit of a bit of a diversifier to the portfolio. First of all, it's not the Mag 7, it's in that 493. It's a strong company with a solid balance sheet. They pay a dividend. And I think the company's also well positioned, whether or not Of course, they're tied to oil and whatnot, but I think that they're doing a lot of investing in kind of, green energy and going climate neutral to 2050. They'll be big players in that space because I think they've learned that they have to evolve. So I just like that company overall, but I do think that oil is going to be a story. There's so much going on in the Middle East right now. I don't think it's necessarily over. And that's an impetus for potentially oil to spike throughout the months coming ahead. And then the other thing is, China, if we keep seeing China, if we see that stimulus there and we see the second largest economy in the world growing, they're one of the biggest consumers of Exxon products. And so I think that company has a shot of growing here.
Talk to me about healthcare. I know this is an area that can get really nitty gritty and niche, but what's going on?
So healthcare, again, this goes to my X mag, right? If you look at the Mag 7 and then kind of start going down the list and start trying to look at the companies that are outperforming the S&P 500, Eli Lilly is one of them. Can't talk today. I think, part of that is the GLP-1 craze and the weight loss drugs, and you have, Novo and Lilly playing in that space. But that company in particular has a big portfolio of drugs, whether it's Mounjaro, whether it's, cancer drugs on FDA trials, Alzheimer's disease drugs on trials and things like this. But I think it's a macro story that's starting to play out. To be honest, I thought that these companies, big pharma companies would do better than they have sooner than they have. They're getting some steam now, but you have this massive aging baby boomer population. People started to consume medical services and these products post COVID. I think that's going to continue, and just strong balance sheet. They pay a nice dividend, good diversifier, defensive play for the market. So I do think it's worth looking at.
Sylvia, when I was growing up on Wall Street, it was all about the mutual funds. Now the funds flows over the last decade plus have just been extraordinary to this new wrapper called the ETFs. At your platform, Defiance ETFs, what are you seeing today in terms of funds flows and kind of where are they going?
Yeah, I mean, this was our best year yet. I think it was the best year yet for the ETF industry. I know you guys have Eric talking about that pretty regularly out there, but it's a multi-trillion-dollar business and state of the world now. And if you look at these big mutual fund companies, I mean, they're all trying to figure out how they can do these conversions to ETF products because I think it's the way of the future. I'll say something bold. I don't think that, I have young kids. I don't think that they'll know what a mutual fund is by the time they're teenagers, right? When they invest, I mean, it'll be like a, rotary phone or something like that. But I just think ETFs are a better product, right? You can trade them throughout the day. They're transparent and they're a lot cheaper. I think the days of expensive mutual funds, I mean, give or take a few, like the market leaders, it's just like have their client base. I think they'll have it for a while, but you kind of have to adapt and go, cheaper, more transparent, unless it's like a super sophisticated active strategy, but that probably still works better in an ETF wrapper. So I think growth continues there.
Yeah, but they're not as profitable to me when I'm trading for Salomon Brothers or Morgan Stanley back in the day. The mutual funds.
No, you're not going to make as much money as an advisor, that's for sure. And that's, but I think if you, the good news is that the types of ETFs that are out there are more interesting. There's a lot of great thematic products, options-based products and things like this. And so an advisor, I think, can now be, really providing a good service by alerting retail clients of theirs that there's all this other stuff out there that they can get exposure to, including Bitcoin, right? I mean, Bitcoin wasn't a thing a few years ago within an ETF product. Now people are putting it in their IRAs. So it's a different world.
It is a different world. And as you mentioned, it is arguably much better for investors. And that's the most important thing. Sylvia Jablonski, thanks so much for joining us, Chief Executive Officer and Chief Investment Officer for Defiance ETFs.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Mulinda sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. I'm going to get right to our next guest here. A very cool story here. Raul Martynek, CEO of DataBank. DataBank is a private company. Tell us what you guys do, Raul, because I think a lot of people are really interested in your business.
Sure. Great to be here. Thanks for having me. So DataBank, we're a U.S.-based company. We're a data center developer.
Data center.
So we have over 70 data centers in 27 markets, giving us the largest geographic footprint of data centers in America. A data center, I like to say, it's basically the foundation for technology adoption, right? You think about anything on your phone, anything on your computer, it basically originates and terminates in a data center. So we support over 2,500 customers, from the major hyperscalers to major enterprises to smaller businesses that want to put their critical data, their applications, their services inside a hardened facility like a data center, because obviously in today's world, everyone's really dependent on their digital footprint.
Yeah, throw me a few names of your customers.
So Amazon, Google, Netflix, JP Morgan,
just the small ones,
PNC Bank. Carnival Cruises.
All right, so even simple people like Norah and I, Nora's much smarter than I because she covers the real estate business. I know that the data center business is a good business.
Booming.
Really good business. Some people want to invest with you, and you just raised some capital. Talk to us about that.
Yeah, so one thing about data centers is they're really expensive, right? We measure everything in power. We call it, by the megawatt, which is 1 million watts. It costs about $10 to $12 million per megawatt to build out data centers. And we're building data centers that are 60 megawatts, 72 megawatts, 40 megawatts. So, we're now in the kind of the billions range when it comes to these investments across the sector. So this week we announced that we had raised $2 billion of equity capital with Aussie Super, which is an Australian pension fund, as our new lead investor with a $1.5 billion commitment.
So, the tech industry, it moves fast and breaks things. But if you think about the utility industry, it's a bit slower and tries never to break anything at all. Obviously, you work as the middleman here. I'm curious, how do you manage the relationships between both ends?
Yeah, that's a great question. These two kind of galaxies are really colliding now. Obviously, we always were good partners with utilities, but over the last 24 months, with the advent of generative AI, the demand for data center capacity has just skyrocketed. To give you some example, in 2020, let's say 2021, right before ChatGPT, there was probably about a gigawatt, 750 megawatts of absorption in the United States for new data center capacity. This year, the estimate is 6 gigawatts of new data center capacity will be absorbed. So our relationships with our utilities are critical. And yes, they are more on the slow moving side, right? They're utilities, they're regulated. They think of things in 10-year cycles. Meanwhile, our customers think of things in 12-month cycles. So there's a lot of activity going on there, but the utilities are, working hard to try to figure out how they're going to meet the expected demand of AI over the coming decade.
So what do you do when you develop a data center? Do you assume the utility is going to be there to support you, or do you build your own power there? Like John Tucker likes to talk about these small. What do
you couldn't build your own power. Like aluminum producer Alcoa had to build its own power, its own dam in the wherever it was. But you can't do something like that.
Technically, you can. That self-generation, right? That is becoming a topic that is much more discussed now than it was before. But ultimately, what we do is, before we acquire land, we're already working with the utilities to understand where they have capacity on their platform, right? We look for, transmission lines that obviously carry the electrons, and then we'll buy land kind of in close proximity to those transmission lines so that we can tap into them to grab power. And that's exactly what we did with the 3 announcements we made this year. We're building a 480 megawatt data center campus in Texas, South Dallas. We worked with Encore there to identify that spot. We're building a 120 megawatt data center campus in Atlanta. We worked with Georgia Power to, again, identify a suitable location. And then we're building a 192 megawatt campus in Culpeper, Virginia, which is about 50 miles south of kind of Data Center Alley, as we call it.
Are you eyeing nuclear plants?
No, most of the power here is kind of, it's a grid mix, right? So like in Texas, Encore is, very proactive in terms of connecting new generation there. Believe it or not, as an example, on any given sunny day in Texas, 45% of the power is coming from solar, wind, and batteries. So there's been a huge investment in those kind of renewable power generation sources.
You guys are based in Dallas, right? So
we are.
We just had a story. You got a pension problem in your city, right? And like an incredibly unfunded pension. And I looked at this story. I'm like, there's a million companies like yours, smart young companies, flocking to Texas, flocking to Dallas. I don't know how you guys got yourself in that pickle in the city of Dallas, but that's another story for another time. So talk to us about this investment here. What are the Australians Did they see this as an AI play for them? What's the angle for them?
Yeah, I mean, what's great about our business is that, we're really a pick and shovel business, right? Data centers are agnostic. It doesn't matter what technology you put into a data center. All that matters is that people consume technology. Okay. That's what I love about our business, that, we're really indexed to technology adoption. And I would argue humans are addicted to technology, right? And that because of that, we think there's going to be, long-term demand. So these investments are very long-term investments. Okay. We build a data center, we expect it to have an operational life of 30 to 40 years. In fact, the data center sector really has only been around for about 25 years. So you still have assets that were built in the 90s during the dot-com bubble that are still relevant and active today. So Australian Super, they're looking to support us as we build out this 850 megawatts that I just described over these 3 campuses. And this equity will help us build those facilities. I
mean, there's insatiable demand right now in the market. How are you all thinking about sustainability? I know you mentioned renewable power.
Yeah, so the good news is that, there's a commitment with the sector, and there's a commitment from the largest consumers of data center capacity, which are the hyperscalers, to a renewable future. So ourselves, obviously all the major hyperscalers, we all have kind of carbon neutral net zero goals. Ours is for 2030. And the major hyperscalers are also in that range. They are the largest consumers of renewable energy in the world. Just read recently, because of Google's announcement about that nuclear, that they consume 14 gigawatts of renewable energy. So these companies have a corporate commitment to renewables, and that creates a demand signal for people to invest because they know there's going to be a buyer for that product.
Raul, thank you so much for coming in. Really appreciate it. Fascinating story. Raul Martynek, he is the CEO of DataBank, is the company. It's a private company based down in Dallas, Texas, the data center business. Boy, even I know that's a great business. So interesting story there, of course.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.